When the stock market starts to pull back, most people panic. But smart investors know that pullbacks are an opportunity in disguise to get into companies with strong fundamentals and long term growth potential. As the famous Warren Buffett saying goes, be fearful when others are greedy and greedy when others are fearful. So, in this video, I'm going to go over 4 stocks that I like in case we have a correction in September, and I'm going to show you the exact levels where you could start building a position in these stocks. Let's go. Hi, my name's Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. Now, before we check out the actual stocks, let's see what's been happening on the macro front. So I'm recording this video Tuesday, September the 2nd, around midday. And if we see what's been happening in the stock market, the Dow's down about 400 points to kick off September on tariff worries and rising bond yields. So let's take a look and see what happened. The Dow Jones Industrial Average shed 411 points or 0.9%, while the S&P 500 dropped 1.2%, while the Nasdaq slid 1.5%, and that marks the first back-to-back 1% decline for the tech-heavy index since President Trump announced his sweeping tariff policy on the so-called Liberation Day back in early April. The moves come after a federal appeals court on Friday ruled that most of Trump's global tariffs are illegal. The U.S. Court of Appeals for the Federal Circuit determined in a 7-4 ruling that only Congress has the authority to apply sweeping levies. Trump called the decision highly partisan and said that he would appeal to the Supreme Court. Now, obviously, these kind of news events bring a lot of volatility in the stock market, and the markets hate uncertainty. So obviously, the 10-year Treasury yields jumped 4.2%, while the 30-year yield topped 4.9% today. To add to that, September is actually one of the worst months for the stock market. And if we see right here, the S&P 500 averaged a 4.2% drop over the last 5 years in September and falling more than 2% on average in the last 10 years. If you look at some additional stats, this is an average of the S&P 500 all the way from 1928 to 2025 for all months of the year. And as you can see, for September, we have an average pullback of 1.13%. So keeping that in mind and additional economic data that is expected this week, like Thursday, we have the ADP employment report and initial jobless claims. And then on Friday, we have the very important US employment report for August. So if those reports don't come in as expected, we could potentially see a larger pullback later this week. If all of that economic data was not enough, we also have the Fed meeting later this month. And right now, the market's pricing in a 91% chance of a rate cut for September. So we'll see how that goes. I would ensure you keep all of these events in mind as you enter any positions in September. So with that said, let's jump into the actual stocks. My first pick is none other than Nvidia. Now, Nvidia needs no introduction. It's the king of AI chips, powering everything from data centers to autonomous cars. The stock's actually been pulling back over the past few days with the news that China's Alibaba is developing its own AI chips to counter Nvidia. However, there are additional reports that the chips are actually not as advanced as Nvidia's AI chips, so I don't believe that Alibaba will pose a threat to Nvidia in the long run. Nvidia continues to lead the stock market with a 4 trillion market cap and is one of the most fundamentally sound companies in the stock market. Looking at Nvidia's 6-month chart, it's down 2.66% today, trading at around 169.56. And if you look at where Nvidia is currently on the Bollinger Bands, Nvidia is actually currently at the bottom of its Bollinger Band. In fact, it actually broke its bottom Bollinger Band and is currently trading slightly below this blue line, which is the 50-day moving average. So keeping all of the September economic events in mind and the possibility of a potential pullback, the next level of support that I see for Nvidia is actually this 100-day moving average, which is the 148.22. And obviously, the next level of support is the 200-day moving average, which is around the $140 level. Now, if we do some math and take the current level and subtract the 100-day moving average, which is this 148 level, and see how much of a pullback that is. So that's about 21 points lower than the current price. And if we take the 21 and divide it by the 169, which is the current price, that's about a 12% pullback. So I like this 148 strike price right here. It's a solid support level, and it's about 21 points lower than the current price of Nvidia. So let's pull up the options chain. And what I'm going to do is actually go out 45 days in this case, because I want to bypass all of September, and going all the way to October 17th would actually build some cushion, allowing the stock to come back up in case there is a major pullback. Looking at the October 17th options chain, we don't have a 148 strike price, which was the 100-day moving average. We either have a 145 strike price or we have a 150 strike price. Now, looking at the deltas of some of these strike prices, the 145 strike price is a 13 delta, meaning there's a 13% chance of the stock to get to this level. Or we can go with the 17 delta, which is again a 17% chance that Nvidia could come down to $150 by October 17th. I don't believe you could go wrong with either one of these levels. If you want to be super safe, you can go with the 145 strike price. Again, it's a 13 delta and has a lot of open interest and volume. Or you could go with the 150 strike price. Now, this offers a better return on your capital and it has a lot of volume and open interest. So I would go with the 150 strike price. So right now, if you sell the 150 strike price put option, you would collect $2.49 in premium per options contract, because one options contract lets you control 100 shares. That's $250 for selling one put option of Nvidia at the 150 strike price. My next pick is Robinhood. Robinhood is quietly transforming from just a trading app to a full financial platform, launching tokenized US stocks and ETFs in Europe earlier this year and providing access to private companies like OpenAI and SpaceX. They continue to improve their trading platform with the introduction of Robinhood Legend, and also focusing on AI with their AI investing assistant Cortex. Additionally, they continue to expand the crypto services and focus on retirement accounts and more. Looking at Robinhood's 6-month chart is actually down 2.8% today, trading at around $101. And if I zoom in, Robinhood is currently at the bottom of its Bollinger Band. So the next obvious level of support that I see for Robinhood is this 100-day moving average sitting at around $80. So let's pull up the options chain. I'm going to do the same thing. I'm going to go out 45 days just to bypass all of September's act. And looking at the $80 strike price, this is a delta of 13. And if you look at the return of capital, this is about a 2.3% return on your capital. And we have a lot of open interest and volume. So I like the 80 strike price right here. So if you click on the bid, the order ticket will open up. And as you can see right now, you can collect $1.82, which is $182 for selling one October 17th $80 put on Robinhood. And if you don't get assigned, then you've collected $182. If you do get assigned at the $80 level, then this would be a great level to build a position into Robinhood and ride it all the way back when the markets recover. My next pick is SoFi, and SoFi is actually one of my favorite stocks to trade on. It's another fintech disruptor that focuses on offering student loans, home loans, banking, investing, and even credit cards to the Gen Z. In fact, I just did a video on SoFi recently and how I believe that it's likely to benefit immensely from a rate cut in September. So click on the link above and check out that video. So I have the SoFi 6-month chart pulled up here on Thinkorswim, and SoFi is currently trading at $24.82 today, down about 2.8%. And if we see where SoFi is trading on the Bollinger Bands, it's actually right in between the top and the middle of the Bollinger Band. So the next level of support that I see for SoFi is this 50-day moving average, which is the 2157 level. Or you could go all the way to the bottom of the Bollinger Band, which is $20.77. So let's do some math here and see. So if we take 2480, the current price where SoFi is trading at, and subtract the bottom of the Bollinger Band, which is $20.85. So that gives you about $3.95 in difference. And if I take that $3.95 and divide it by the 2480, where SoFi is currently trading at. So that gives you a cushion of about a 16% drawdown. Let's go to the options chain and see what kind of premium we could collect at this level. So I'm going to pull up the October 17th options chain again, going out 45 days. We either have a $20 strike price or a $21 strike price. And looking at the deltas for these, the $20 strike price is a 14 delta. Now, this is about a 2.17 return on capital. And as you can see, we have a lot of open interest here at the $20 level. And if you look at the $21 level, the open interest is just $55.77 compared to $36K at the $20 level. So I certainly like the $20 level much more than the 21 level. I would go with the $20 strike price. So basically for selling one put of the $20 strike price on SoFi, you would collect $42 in premium, and that would be a return of 2.17% on your capital. And if you don't get assigned at that level, the premium is yours to keep. If you do get assigned at the $20 strike price, I believe that would be a fantastic price to build in a position into SoFi and ride it all the way back as the market recovers. Last but not least, my final pick is Google. Google is still a cash machine with its ad business, YouTube dominance, and the cloud expansion, including the recent 10 billion cloud deal with Meta for AI related services. Google is one of those companies that just doesn't go away and would make a fantastic addition to anyone's portfolio. So looking at Google's 6-month chart, Google's currently trading in between the top and the middle of the Bollinger Band, trading around $210 right now and down about 1.2% for the day at the moment. So looking at support levels for Google, I see the next support level at the bottom of the Bollinger Band, which is the $193. And if we go slightly further, then we have the 50-day moving average at around $191. So keeping in mind that Google's currently trading around $210, a 190 strike price would be about a $20 discount from the current price. Or if you want to be even safer, you could go with the $185 strike price, which is in between this 50-day moving average and the 200-day moving average. Going with the 185 strike price would give you a discount of about $25 from the current price. So let's do some math. If we go with the 190 strike price, which is about a $20 discount from the current level, which Google's around 210. So if I just take the $20 discount from the 210 strike price, it gives you a drawdown protection of about 10%. And then if we go with the $185 strike price, that's about a $25 discount from the current strike price, which is 210. That would give you a protection of about a 12% drawdown. So I like the $185 strike price. Let's pull up the options chain right now and go to the October 17th options chain. And if I look at the $185 strike price, that is a delta of 13. We have a lot of open interest and volume at this level. Not the greatest return on capital, but the $185 would be a great strike price to begin a position into Google in case there is a pullback. And again, the $185 strike price gives you a protection of a 12% drawdown. So if I click on the bid right now, you would collect about $180 in premium by selling one put option at the $185 strike price. If Google does draw down by about 12% and get to the $185 strike price, that would be a fantastic place to start building in a position for Google. So that's it for today's video. If you enjoyed it or learned anything useful, don't forget to hit that like button, subscribe to my channel, and comment down below with your thoughts or any questions. If you would like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out.